Let's go straight to the point. HBAR is currently trading in the $0.094 to $0.1 range. Different platforms show slightly different numbers, that's normal. Prices update constantly, and each aggregator has its own methodology. What matters is this. Based on recent data, the 24-hour spot volume on major exchanges sits roughly in the $10.96 to $14.5 million range. That means the market is active. It's not a dead coin, but we also don't see explosive volume that would signal aggressive buying by big players. What happened over the last 24 hours? We saw a spike up to around 0.1029. That's the local high of a recent impulse move. After that, price cooled off and went into consolidation. Classic behavior. You get a push, then a pullback, then the market thinks. And this is exactly where the real game starts. One of the fresh technical write-ups from late February 2026 notes HBAR trading around 0.1 with a 5+% gain over 24 hours and frames it as renewed buying interest after recent consolidation. But in the same breath, it points out mixed technical signals. That's important. When even a bullish read comes with caveats, it doesn't mean do not buy. It means respect risk and position sizing. Technical analysis, going through the indicators one by one. Let's walk through the indicators that actually matter for this time frame. I won't throw 20 tools at you, just the ones that give concrete signals right now. RSI Relative Strength Index. On the 14-day time frame, RSI is sitting in the mid-40s to mid-50s, basically a neutral zone. What does that mean in practice? First, the good news. RSI is not overbought, so there is technically room to the upside without an immediate "you're too hot, cool down" signal. Second, neutral is not a buy signal. When RSI is below 50, sellers still have an edge. When it breaks and holds above 50, that's the first confirmation I'd want to see for a medium-term bullish scenario. MACD. Here, things look more hesitant. The MACD line and signal line are almost on top of each other around the zero area, and the histogram is very close to zero as well. That screams indecision. No clear bullish crossover, no strong bearish impulse. The market is sitting at a decision point. For a trader, this means one thing: wait for confirmation. You want to see a clean bullish crossover and the histogram turning positive before calling it a real trend shift. Bollinger Band. This is one of the most visual indicators for the current setup. The lower band is around 0.09. The middle band, 20-period SMA, is near 0.1, and the upper band is near 0.11. Price has been moving between the mid and upper bands. When the bands expanded on that move to around 0.10297, that was a sign of volatility waking up. Expanding bands mean the market is stretching. The only question is, in which direction is it going to resolve? Moving averages 50 SMA and 200 SMA. This is where things get very clear. The 50-day simple moving average is around 0.1027. Price is trading below it. That's a bearish sign on the medium-term chart. Sellers are technically on top, and buyers need to fight their way through that level. The 200-day SMA sits even higher, around 0.16, and is still sloping down. That tells you the longer-term downtrend from previous highs is not broken yet. To talk about a true trend reversal, you want to see price reclaim the 50 SMA, hold above it, and only then move toward the 200 SMA. That's a process, not a one-day spike. Stochastic. I like to look at stock in combination with RSI. In late February, one snapshot had %K up near the 70+ area building momentum, but approaching the zone where we have to watch for overbought conditions above 80. Another snapshot a day or two later showed %K and %D down near the teens oversold territory, hinting at a potential bounce. The spread between these readings shows how fast the short-term picture can change. which is exactly why medium-term traders should focus more on the weekly structure, not just day-to-day swings. ATR average true range. ATR sitting around $0.01 tells us volatility is moderate. In practice, with price around 0.0950.1, that's roughly a 10% daily range. So it's not a stable coin, but it's also not pure chaos, where your stop gets hit before you even understand what's happening. Set your stops with that range in mind. Key levels you must have in your head. Let's make this simple. These levels matter more than any opinion. $0.09 critical support. This is the lower Bollinger Band and a psychological level. If price breaks below and closes there, that's not just a routine dip. It's a signal that buyers stepped away and the medium-term thesis needs to be reevaluated. $0.1 the pivot, the decision point. That's roughly where the middle Bollinger Band sits. As long as price stays above it, buyers still hold the field. Once 0.1 is lost, pressure shifts downward and 0.09 becomes the next logical target. $0.11 first major resistance and breakout trigger. It's near the upper Bollinger Band and a level where sellers have stepped in historically. Multiple independent technical analyses highlight 0.11 as the key bullish breakout level, a level where a proper upward continuation can begin if taken out with conviction. And conviction here means with volume, not just a thin wick on low liquidity. 0.1027 the 50-day SMA, that's currently acting as dynamic resistance above price. 0.1, 40.1, $6 the medium-term upside target zone if the bullish scenario plays out. Several institutional-style forecasts line up in this band for the next month or so, and the 200-day SMA sits right in this region as well. That's where you'd expect serious profit-taking and strong reaction if we get there. 3 scenarios for the next 4 weeks. Now the part everyone cares about, scenarios and what would confirm each one. Scenario 1, technical reversal and push higher. This is the bullish path. Conditions. Price reclaims and holds above 0.1. RSI breaks and stays above 50. MACD flips into a clear bullish crossover with a positive histogram. Volume expands to at least 2-3 times average daily volume on the move up. If this lines up, the first target is 0.11. If 0.11 breaks and holds with volume, the door opens to 0.14-0.16 toward late March or early April. Some analyses even note that a clean break of 0.11 could trigger algorithmic buying, accelerating the move toward those monthly targets. Scenario 2, sideways range and accumulation. Price continues to chop between 0.09 and 0.11, grinding traders' nerves down. This is the most likely scenario in a market that isn't ready yet to pick a direction. Some 2026 projections literally map out a minimum around 0.0926 and a maximum around 0.113. That's your box. Trading in this phase is tricky. Either you play the range edges with tight stops, or you step aside and wait for a break. Scenario 3. Support breaks and we get a deeper correction. If 0.09 fails convincingly, the next significant zones lie notably lower and the current medium-term thesis breaks down. What could trigger this? Broad market risk off, another leg down in Bitcoin, or a negative regulatory or partnership headline. Given ATR around 0.01, this is more likely to look like a slow grind rather than a flash crash, but psychologically, that kind of slow bleed can be harder to sit through than a sharp dump and quick rebound. Fundamental backdrop. What's actually behind the coin? Now, why is HBAR interesting on a medium-term horizon at all, not just as candles on a chart, but as a token with an actual story? FedEx joining the Hedera Governing Council. This is arguably the biggest headline of February 2026. One of the largest logistics companies in the world joined Hedera's Governing Council, launched a node, and became part of network governance. That's not just some speculative "we bought a bag of coins" play, that's infrastructure adoption. FedEx is using or planning to use Hedera's tech for real business processes. The market partly priced this in during February, but corporate narratives like this tend to unfold over weeks. Institutional analysts dig into the implications, and medium-term capital rotates in later. February 2026 recap: Davos, carbon markets, Dev Day. In the February recap for Hedera, several themes stand out. Presence in the Davos-level conversation around real-world assets and carbon markets, further ecosystem growth, and the Hedera Dev Day 2026 held on February 17 with Lehman Baird and other key figures on stage. These events don't always spike price on the day, but they shape how builders, partners, and institutional players perceive the network. That's exactly what matters on a 1-4-week horizon and beyond. RWA tokenization of real-world assets. The real-world assets narrative remains one of the major drivers across crypto in 2026. HBAR positions itself as an enterprise-grade infrastructure for tokenization. Every time a new big case study or regulatory movement in favor of tokenized assets comes out, Hedera tends to get renewed attention from institutions. It's not an instant pump trigger, but it's the kind of structural tailwind you want behind you. The governing council as a competitive edge. This is a point many overlook. Hedera's council includes names like Google, IBM, Boeing, Deutsche Telekom, LG, and now FedEx. That's not just a committee of anonymous token whales. These are corporations with real operating budgets, reputational risk, and incentives to keep the network stable and useful. For a medium-term investor, that dramatically reduces the risk of HBAR being just another alt that disappears in the next cycle. What sentiment data is actually telling us? Let's talk about something people love to mention but rarely use correctly. Sentiment. Right now, fear and greed type indexes for this market cluster around extreme fear in the 10-14 range. That needs to be understood correctly. Extreme fear is not a panic now signal. It's a marker that the market is extremely pessimistic. Historically, those are the periods when accumulation with a multi-week horizon can make sense. But, and this is crucial, extremes in sentiment can last longer than you expect, and by themselves, they are not a buy signal. On the social side, HBAR shows a large tweet volume, over 12,000 posts, analyzed in one snapshot with bullish messages outnumbering bearish ones, while most remain neutral. The way to use this is simple. An increase in bullish noise on social media is not a reason to ape in. It's a sign to double-check whether we're approaching resistance and whether smart money might be preparing to sell into retail optimism. If bullish sentiment rises together with strong volume and clean technical breakouts, that's confirmation. If it's just noise without volume and without key levels breaking, be careful. How to think about entries and risk. Let's make this practical. Conservative approach. You wait for a break and close above 0.1 with clear volume expansion. That lowers the risk of a fake out, but you'll miss some of the initial mood. This is for traders who prefer higher probability over catching the exact bottom. Moderate approach. You treat 0.0950.102 as an accumulation band, basically the current trading range. You start scaling in there, keeping dry powder to add on a confirmed break above 0.11. Your stop goes below 0.09. Aggressive approach. You buy near the lower Bollinger Band around 0.09 with a tight stop just below the recent lows. High reward potential but maximum risk. If 0.09 fails, your stop will get hit fast, which is the point of a tight stop. Risk management. With ATR around 0.01, you should assume 10-15% daily swings as normal noise. Position sizing should reflect that. A reasonable rule of thumb: don't risk more than 2–3% of your total portfolio on this idea before the market clearly picks a direction. Time-based outlook: here's how I'd frame it across specific time windows. Next 1 week. Likely trading range: roughly 0.09–0.104. As long as MACD hasn't flipped bullish and RSI hasn't convincingly moved above 50, the market is likely to remain in consolidation. The key weekly event is whether price closes above or below 0.1. Next 2–3 weeks. In the bullish scenario, we test 0.11. If that level breaks with strong volume, we might see continuation. If not, we get another rejection and drop back into the range. Several analyses explicitly mark 0.11 as the main resistance to watch on this time frame. Next 4 weeks into late March, if the bullish path plays out, the 0.140.16 area becomes a realistic medium-term target. That's where multiple projections converge, and where the 200-day SMA will be waiting as major overhead resistance. In the bearish path, a loss of 0.09 opens the door to a deeper, slower correction and pushes any recovery expectations further out in time. Bottom line: an honest look at probabilities. I'm not going to tell you HBAR is going to 0.2. Buy now. That would be dishonest. Here's the real picture. Technically, the market is at a crossroads. RSI is neutral, MACD is flat, Bollinger Bands have tightened after a volatility burst. This is a classic setup phase, where the next 1 to 2 weeks decide the direction. Fundamentally, Hedera is in one of its strongest positions ever. Enterprise adoption, real corporate names on the council, FedEx joining, presence in RWA and carbon market narratives, and a live dev ecosystem. Sentiment-wise, extreme fear tells you that most people are leaning negative. Historically, those are the periods where disciplined, level-driven accumulation can pay off, but only if you respect risk and are prepared to be early. So my stance is this: I watch 0.1 as the weekly pivot. I treat a clean break and hold above 0.11 with volume as confirmation of a medium-term bullish leg. I keep my invalidation below 0.09, and I don't oversize the position until the market proves it actually wants to trend. It's not the most exciting approach, but it's the kind that protects capital and still allows you to capture the move when it really starts.